Hey, y'all. If you're just tuning in, I'm Steve Gibbs. I'm here with Jason Kenyon, and we're glad to be here with Barry Brooksby. We've been traveling the INE journey for some time. This is the first time for you guys. Welcome. Really glad you're here. To us, as having an estate planning attorney background, we really like to talk to people about various strategies of all kinds, wealth transfer, real estate, building your personal definition of what wealth is. And Barry's been a big part of that with us. And we want to get him on and pick his brain and kind of, have a good discussion to draw out some of these things that Barry's working on every day. So Barry, welcome.
Thank you.
Excited to have you. I want our audience to get to know you. And I think one of the best ways to do that is to kick off maybe some things about you that nobody really gets to know in terms of just watching your videos and things like that. So I'm always excited because you have a lot of things that are fun to share. For one, you can rip on the guitar like Van Halen pretty much. So I'm disappointed we're not having you do that today, but maybe that's another video.
There we go.
So Barry, years ago, you started out as a college level guitar teacher, basically, correct?
I did. That was nearly 30 years ago. And what's interesting about that is teaching at a college level and even private students for many, many years, I had a very kind of in your face, hey, this is how you do things the right way. This is how you do things the wrong way when it comes to teaching people. How do people learn? So I really like education from that perspective because we all want to be educated properly, and music and teaching in that world really gave me a solid foundation of teaching correct principles or correct ideas to help people accelerate their learning. When you see someone get frustrated about playing guitar, there are things that you can do very easily to help them make that process.
Well, I'm one of those people actually, so I can relate, and I love this topic. I cross paths with a lot of guys, my age and in our industry that are scribing guitarists. So it's pretty funny, that. So how do you equate some things similarly between finance and playing guitar and just learning in general? What really makes you tick on this stuff?
Yeah, I'm going to give you an analogy. And it's funny we're talking about this, but I was at a friend's house a couple weeks ago and I said, hey, do you have a guitar in your house that I can play? He said, yeah. His wife grabbed the guitar. The action on the guitar was very high, meaning the strings were far away from the fretboard and the gauge of the string was very heavy. And I said to him, hey, if you ever have a family member that wants to play guitar, there are two things you can do right off the bat to make this guitar play easier. And the same thing can hold true in someone's financial life. But many people aren't seeing it because they're either being educated incorrectly or they're in the circle. You need to step outside of the circle sometimes to be able to see things a little bit more clearly and get a fix pretty rapidly when you're talking to someone that understands maybe the nuances of those things.
Well, because music is a language, right? And there's a way of looking at it, and your mind can open up to new things as you learn it. You're saying the same goes for financial abundance, financial strategies, and the things that you're involved in every day.
Yeah, it's true. I remember growing up as a kid watching my parents invest in real estate. We might get into some of that today. And then when I did get into financial services coming out of the music world, I was taught a lot of inaccurate things, but I had within my gut and within my heart to be a real estate investor, but I wanted to do it correctly, not only in real estate, but in other areas. And when I got into the financial world, I saw that a lot of people were educating the wrong way or simply passing on what a mentor had told them or what a boss had told them. And that's really what we see today in America is there's this overarching way that we're educated financially that isn't always correct.
What do you think the biggest problem is for people with finances that you've seen? You've talked with probably thousands of people at this point.
Well, number one, they're taking advice from the wrong people. And what I mean by that is typical financial advice is you get a job, you start a 401k, you max out your 401k. If you've got more discretionary money, you're going to open up an IRA, and everything's market based. And when you think about market-based investments, there are major problems. And I'm not saying don't ever invest in the market. I even have some individual stocks. But when you invest in the market, you're dealing with volatility. Most of the time, when you take that money out, it's 100% taxable. And then you're also paying fees that legally don't have to be disclosed. And there's a bunch of third-party information out there that you can discover. But when you follow that traditional financial advice and you get to retirement, because I've seen this over and over with my clients, they get to retirement like, oh my gosh, nearly all the money I have coming to me, I've got to pay tax on. And my portfolio isn't the size that I thought it was going to be. What my financial advisor told me it was going to be, or the HR department of my company that was kind of managing me my 401k, those dollars aren't what I thought they were going to be because of the volatility. So I want people really to invest in a diversified way, which means different asset classes. Diversification isn't buying more mutual funds or a different ETF. That's all still market-based. True diversification comes from investing in different asset classes.
I think we saw that with the stocks and bonds, right? So I think it was last year, stocks and bonds both had like a negative return so even when you think you're diversifying, a lot of times, if it's all market based, you're really not diversifying the way that you need to be.
Yep. That's a true statement. We want people to look at not only market-based accounts, some real estate if they're interested, not everyone is, but then you also get into what we discuss, high cash value whole life insurance. They might be into some crypto. They might be into credit instruments or debt or private financing. There's other ways to invest besides straight stock market mutual funds or bonds.
Yeah. And backing up just a second, Barry. So people are thinking, they're just tuning in and they're thinking, why do I listen to Barry? You've been in the conventional financial area. So this isn't like you're speaking out of school or something. You went that route. You ran into some concerns, correct?
Yeah, 25 years ago when I started in financial services, I had a mentor. Well, what would happen was my summers would slow down from teaching music. And so a friend of mine, financial mentor, said, hey, I want to get licensed, got licensed, was putting my money and my clients' money in the market. So I've got a lot of extensive experience in those market-based accounts, the mutual funds, the IRAs, etc. And what I saw very quickly was, one, the market does go up and down, right? They want to tell us all about the good. And even my mentors, and this was back in the day, he's saying, your clients are going to earn 12% and 18% returns. And it looked great on paper. Mm-hmm. But when the clients are coming back to me a year later saying, Barry, I lost 18% or I lost 12%, for me, new in the business, I started asking questions and wondering.
Wait a minute now. You're saying that 12%?
What's that?
Barry, you're saying that 12%? Is that? I don't want to get into that too much, but you're saying that could be a concern if someone's counting on 12%?
A huge concern. And there are still people out there that are promoting these large double-digit returns in the market. And historically speaking, we don't see that year in and year out. But that's what I was being taught. And because I was being taught that from someone I respected, a mentor of mine, I was teaching the same thing. But looking at the results into that, it wasn't coming to fruition. And that's when I decided, look, I've got to find something better. I've got to find something that's guaranteed, predictable, tax-free or tax-advantaged. Because what I was selling and what I was being told to sell wasn't meeting what they were saying it was going to do.
Well, let's drill down on that. So I know we're teasing with some benefits and things like that. What you got away from the conventional because of the cycles and because you started losing sleep. You and I have talked about that before. So you're talking about diversifying, right? We're talking about asset classes. Maybe unpack that a little bit. We want to get into the idea of buying assets. We want to help challenge maybe some of the thinking that's out there. There's so much noise around this topic. We hear it every day. But if someone's just now trying to figure this out, where's a good starting point? But looking at assets, right? But
Sure. I would always tell someone that education is the best place to start. So read the books, Robert Kiyosaki books, the financial books, read the books that talk about the different asset classes and look at what the wealthy do. There's a reason that the Rockefellers are still a wealthy family, and from one generation to the next, they continue to perpetuate that wealth. You ask the question, well, why? Why does that happen? So you drill down and discover things about what they're doing specifically. If you look in America, we are financially educated by Wall Street. And they educate us because it's in their best interest. And they're going to say things that are in their best interest. Again, put money in a 401k, put money in the IRA, ETFs, because everything that's in those accounts, they make money on every year. Whether you lose money or make money, they still make money. I've always thought it would be fair. If you got a 20% down year in your portfolio, Wall Street should be losing 20%, and so should your financial advisor. But it doesn't work that way. They still earn the fees off of that total portfolio. So you can keep money in the market, and if you're getting a match on your 401k, that can be a good thing. But the diversification of different asset classes, if you like real estate, look at real estate, read the books about real estate, discover what are the key things you need to know about real estate, cash on cash returns and net operating income and all that stuff. And the tax.
Well, you're an investor too, so you're not talking out of school on that one either.
No, I've been a 17-year real estate investor, and I love real estate because it comes with natural tax benefits that you can't get in a lot of other places. You might be very good at day trading. Maybe that's what you do as a full-time job. But I've often heard that an investment can be less risky the more you know about it. So if you're interested in learning about a particular type of investment, don't throw money at it blindly. A lot of people today investing in the market wouldn't be called investors. They would be called speculators because they're not really learning about the companies they're investing in. And if you've got a mutual fund, remember, that's just a conglomeration of different stocks. And that mutual fund manager, they can buy in or move stocks in and out of that fund. They don't need your permission to do that. So diversification really is crucial. And that's what I learned 25 years ago when my clients were coming back to me saying, where are these double-digit returns you told me we were going to get? It scared me. And I did lose sleep at night. And I know my clients were losing sleep at night. And because it scared me, I wanted to go do something about it. I couldn't just sit back and say, oh, never mind. My advice to my mentor was tell your clients they're in it for the long haul. And I just thought, what a cop-out. That didn't work for me. My personality is integrity, honesty. I want to do what's right for my clients. But because it scared me, it forced me to go find something better. And you don't want to learn the hard way, right? If you can learn from someone else's mistakes, run with that. And what I discovered was the power of real estate investing and the power of high cash value whole life insurance. But my whole life insurance journey didn't start until I had some bad experiences with universal life products, in particular.
If you're just thinking of stopping this video, just hold up for a second, because Barry's unpacked a strategy, right? And we haven't gotten to why this is a powerful asset yet. So hang in with us. if you feel like, this is about whole life, we get that, and we have to explain it. I mean, but before we get there, Barry, I was going to ask you, a lot of times the obstacles are the path, right? A lot of times our hang-ups or our missteps teach us. What's the toughest financial problem or issue that you've ever walked through yourself? I mean, how do people know, like, has Barry been through the valley a little bit?
Yeah, a very, very low valley. So I was heavily involved in real estate in 2005, 2007, 2008, and 9, and went through that crash in 08 and 09. And I was living in Las Vegas at the time. And Vegas was
a tough market.
The hardest hit, yes, the hardest hit foreclosure city in all of the country. And I lost some property in 08, and it was brutal. It was brutal for me. It was brutal for my family.
You lost property because renters just had to leave, or?
Yeah, and I was heavily leveraged. I mean, in real estate, the idea is debt. You're going to leverage debt, borrow the money. But when you have tenants that can't pay their rent, and that happens many different times, there comes a point where you can't hold on to the real estate. Not only that, but the real estate, I mean, it went down in value. It dropped nearly overnight by 40, 50%. So it was very difficult to hang on to real estate. So I suffered through that, going through the foreclosures and seeing that happen. But I also pivoted. I started buying foreclosures with some investment friends, and we made money in that world too. I've always said, whether the real estate market is good or bad, there's always a deal. You can always make money in real estate, but it takes education to get there. But going through that experience, it taught me a lot. One, don't be too over leveraged. And what I mean by that is, you got to look at your worst case scenarios. If you do go through another real estate market crash and you lose half of the value and 75% of your rents go away, what are you going to do? So you've got to be prepared for some of those things. But yeah, 08, 09, it was a brutal time. It was the school of hard knocks. I didn't go through any of that education reading about it. I went through it personally. It was a nightmare. But I feel like I've come out a lot stronger and more well-educated because I went through it myself.
Yep, I can relate. I was in Fort Myers, Florida at the time, which is another, and that was tough, 60%. So, the idea of being over-leveraged is a hot topic these days. I know there's financial pundits out there that people are very devoted to, that talk a lot about debt. So debt's a hot topic. I think your philosophy around debt, I think, was partially, it seems like it was formed by that experience, but also what you've learned about utilizing the overfunded whole life cash value asset. So I think we should dive into that. And I think there might be some real estate investors listening that are wondering maybe what this entails, right? What's this asset? How do you use it? How does it impact your investing and how do you counsel clients about it? I think those are all really interesting aspects of what you do every day.
Yeah, I want to weave into that by saying there is a place for debt, but smart debt. We want to avoid the consumer debt. But if you've got good debt, good rates, and you've got good cash flows, the problem with 08 and 09 is, the entire country crashed and we just weren't prepared for it. The way that I use debt today, I still do some bank financing, but I use my high cash value whole life policies that are specifically designed for the infinite banking concept for the down payments on my real estate deals. And someone might be saying, why would you use a life insurance policy to buy real estate? Here's why. When you take a policy loan, the insurance company doesn't physically remove the money from your cash value. They put a lien against it. What that means is you're still making money on your total cash value. So if you've got $100,000 of cash value and you take an $80,000 loan for down payments, you're still making money on the $100,000. It's powerful. Now you got cash flow on the real estate, you're making money in your policy, you've got two investments making money for you at the same time. It is true you've got a loan with the insurance company, but we show that that's negligible because you're making more in the policy than what you're being charged in the loan in most cases. When I discovered that, it helped me to see that I can make my real estate deals more valuable. And on the back end, when I choose to sell or refinance or whatever the case might be, I'm going to make more money because the policy allowed my cash to continue to grow at a compound growth rate. The other thing in these policies that I love and my clients love too is you're making money every year. It's compound interest. And we all love that phrase, compound interest. You can't earn compound interest in the stock market. Anytime something's volatile and you can lose money, the compounding goes away. So if your financial advisor is telling you, oh, you're going to make compound interest in this mutual fund, it's a red flag. You can only make true compound interest if you have a guaranteed rate of return, right? That's it. It's got to be a guaranteed rate of return if you're going to go on this hockey stick curve. So I love that the fact is in the policy, you are guaranteed to make money every year. It doesn't matter what's happening in the economy, doesn't matter what's happening in the stock market. We have a contractual guarantee from a mutual insurance company, 120 plus years old, that says we're going to pay you not only a guaranteed return, but you're going to participate in our profits, which is a dividend. We get an annual dividend coming back to our policy cash value. And there are other benefits we can get into too, but those were the two compelling things to me. When I saw that coupled with real estate, boom, it just enhances your real estate portfolio dramatically.
Right, because you can pour that money back in and then pull the financing out. And it's kind of a volume thing, right? We've been talking about volume a lot lately. And so you're taking a large, maybe a portion of your profits, your cash flow, putting it back in, and you can pull it out. And you've got this guaranteed growth and dividends that are based on that. I really think, when I first learned about this concept, and it actually propelled me and then Jason as well in his own experience, you may want to talk about that at some point, but into this area. Somebody told me about the concept of the backwards bicycle, and it was basically this idea that, if you're looking at something a certain way, you might want to, this was an analogy to completely changing your thinking. It kind of goes to your guitar analogy a little bit, and looking at, if someone looks at a guitar, they see a blank fretboard. They didn't even know it's called a fretboard probably, but they don't know anything about that language and what it is, right? And it's this, so they need to have their thinking jarred, and eventually, hopefully, it will click. That's what's happened with us over the years. We can speak from experience, and I know that's what really got your attention, it sounds like, as you were already an investor, but then you brought this into your investing.
Yeah, the infinite banking portion didn't come until later. I was already doing real estate. And so when I saw the infinite banking idea, because I knew about life insurance 25 years ago, it just enhanced it. And Steve, you mentioned something that sparked a thought in my mind. Volume, that's true, right? Run as much volume through these policies as you can. Income, lump sums, etc. But what do the wealthy do? The wealthy leverage assets. They use assets to their advantage. So I'll use a real estate example. If you've got $1 million property with a loan of say $300,000, you have $700,000 of equity in that property. You can go do a cash out refi, tax free, and go put that money to work. Uncle Sam isn't asking you to pay a dime of tax on $700,000. The same thing holds true in these policies. If you've got $1 million of cash value in your policy, 95% of it is available to leverage, to go buy more assets, and it's 100% tax-free. So why not take advantage, do what the wealthy do, leverage assets, and go buy more assets?
Yeah, that's powerful.
Can you speak to volume one more time, though, so people truly understand what we're saying? Because Wall Street's going to tell you put 10% in your 401k or match, and then maybe a little bit more here and there, but you're basically told to save 10% of your paycheck. So what's volume when it comes to infinite banking?
Yeah, what if you were running a good portion of your paycheck through a high cash value whole life policy rather than earning, and I'm just going to use a conservative nominal 5% return, rather than earning 5% on your 10% stock market contribution, what if you were earning 5% on a good portion of your entire income, right? I mean, that alone, volume idea dramatically enhances the amount of money that you're going to make. So whether it's a good portion of your income going into a policy or also adding some lump sums, there are ways to kind of structure policies to get a large amount of cash into these policies, and everyone's situation is different. But that idea of more money going in and creating higher volume allows you to make more money, not just on 10% of your earnings.
Wow. So to unpack that, if you're saving 10% and you get a return on that, fantastic. But it's a lot different than rolling a larger percentage in and getting that continual compounding guaranteed growth, which we really want that to click for people.
Yeah, we do. Because then you can take policy loans and either pay bills or invest in
Put
other
10% in the
assets.
stock market.
Yeah, that's right. And I have some clients that do that. They'll take a policy loan and go invest elsewhere in the stock market. But the same thing holds true. They're now making money in two places. But volume is huge because we want people to think differently. This is a contrarian way to think. This is not traditional financial advice. I don't know too many people that have gotten wealthy because of their 401k.
Nope. And Barry, if we look at what we're talking about here with the volume, and we look at our income and we say, well, I can do, X amount of money. What is maybe the drawback to this as well as the positive? We see the positive. Volume is amazing, and over time that compound interest on all your income could be astronomical. But Nash did tell us, this is like a goal to shoot for, not necessarily something that, we do right away. Because my one thing is if I think about this, the one issue that could come up is cash flow.
Yeah.
Does that make sense?
Yeah, and I was just on a call this morning with a client that asked me, Barry, why are people opening up multiple policies? This is one way that people do it. They might start a first policy at, say, $20,000 a year, and they have more discretionary income, so they start a second policy at another $20,000 a year. So as you said, they can ease into it. They can go incrementally and add multiple policies throughout their life. That's what I've personally done, is debts go down or cash flow increases, and a lot of my clients have done the same thing. Or if you've got a real estate property that sells, or a business that sells, or you've got a large stock option that you're going to sell, whatever the case might be, you can put lump sums into the policy. But it is easing into it if you need to.
Yeah, and I feel compelled to speak up. If this sounds interesting, you got to have the right policy, got to have the right person helping you. Don't run out at hearing this and go try to get a bunch of policies. It might most likely backfire, right? So we want you to be wise, and this is why we do what we do, to really help people figure this out, coach people, talk it through. There's an overall, this can be a long-term learning process for people.
And Steve, I'm glad you said that, because not only are not all policies the same, not all companies are the same, and not all advisors are the same. I can tell you horror stories of someone that met with me and they chose to work with their local guy, and 2 years later they're coming back to me asking me to unwind a problem. That has happened. Mm-hmm. But Jason, I want to talk a little bit more about your question, like what's the negative? Because cash flow could be a negative. What if someone loses a job or there's a shift in their income? These policies naturally have flexible premiums.
Right.
So that $20,000 a year premium I was talking about, you're not locking into paying $20,000 a year for the rest of your life. That policy might have a minimum annual premium, depending on the company, between $3,000 and $5,000 a year. So you can always go down to the minimum. And if you're like, look, I don't even have $3,000 to $5,000 to make the minimum premium, you let your cash value make the premium payment for you till you get back on your feet. But if someone remembers anything from the podcast today, remember the word flexibility. We want to make sure that this works for everyone based on their own financial situation.
Yep. So that was my next question that I was going to follow up with is we can design these policies so that the minimum and maximum, there's a large difference in the minimum that you have to pay, the maximum that you can pay. And can you just speak to that one more time and kind of explain why these policies are different than a traditional whole life policy?
Yeah, 3 days ago, I was on a call with another client. He was going to put in $60,000 in the first year. Most of that is lump sum. But her minimum premium on that policy was about $355 a month. And it's like huge. She can go as low as $355 a month or up to $60,000 a year for 7 years. That's a lot of money to be able to put into a policy.
That's
so
crazy
she walks
flexibility.
away from the conversation. Sorry?
I said that's a lot of flexibility.
Yeah. And even if it isn't that flexible, what if it were $2,000 a year and up to $20,000 like I mentioned earlier, or whatever the case might be? It does depend on what a person gets approved for, their age, their health, and how they want the policy designed. And I take care of all that, for them as far as the design. But people need to understand this is not traditional whole life. So if you're coming on and learning a little bit more about me, I started in the world of selling people the wrong type of life insurance. I did that. But I pivoted about 12 to 18 months after I discovered it was the wrong type of life insurance. And since then, I've been doing the correct design, the correct companies, the correct policies. That you need to understand there is a way that you can have this set up for you that makes financial sense, that you don't have to worry about, I am locking into this premium for the rest of my life. Because look, there's some financial pundits out there, entertainers out there that are completely missing the ball and giving misinformation about what we do, which is infinite banking and properly structured whole life insurance. Traditional whole life insurance is not the same as high cash value whole life, specifically designed for infinite banking.
Yeah, coming from the legal protection world, it's a little baffling to me, Barry. When we hear people that literally have a stigma of whole life in their brain, like an alarm bell, and blares in their head as soon as they hear the term, whole life. And personally, I view traditionally designed whole life as a good asset. Now, what we're talking about is an overfunded, product that's maximized to hold and grow cash inside of the policy, right? So, but to me, it's like, this is a long-term, permanent, liquid asset for people. And so it's funny that it's to me, I mean, again, I'm not coming from a background as a financial advisor. And so I'm a little baffled. I really think that the battle for dollars has really had a calculated strategy to kind of demonize whole life in general. Is what it is.
Yeah, and the two of you, I love the relationship because the two of you are estate attorneys. You understand estate creditor protection. You understand estate planning. You understand legacy. There is no better way, in my opinion, to leave legacy than life insurance, especially whole life. Term insurance will expire. So if someone outlives their term insurance, that money has gone down the tubes. And I've got some term insurance, and I'm not saying don't ever have term. There's a need for it. But if your term insurance expires and you wanted to leave something for your kids or grandkids or great grandkids, you're not going to be able to. Whole life insurance, think about it, and you guys know this, it's guaranteed to pay a death benefit. Like, who doesn't want that? You know you're going to be able to leave your family some type of legacy. And the other thing is, when term insurance expires, that usually happens when a person retires. Now, if they have no life insurance, man, there's a ton of pressure on their assets to perform, right? There's no more death benefit. And I haven't talked to anyone like really in retirement that doesn't want life insurance. You might talk to some young people or someone in their 40s or 50s. Oh, I don't need life insurance. I'm going to self-insure. When it happens and you're retired and there's no money coming in, people tell me, man, I'm so glad I have my life insurance policies. I can spend and enjoy my own money now. And I've got this death benefit I can leave behind. Because look, if you don't have life insurance in retirement and you start spending and enjoying your own money, you're gonna feel like, maybe I shouldn't do this. Maybe I shouldn't spend all my money because I do want to leave something behind. Having a whole life insurance policy when you pass away is going to give you peace of mind. Your family's going to be grateful. And you might be that grandpa that your children, grandchildren, and great-grandchildren are talking about for decades because of what you were able to do for them. My own grandpa did that for his wife, my grandma. And we went on some amazing family trips. There were like 50, 60 of us, cousins, relatives. And it was all because my grandpa planned right. Wow. He left his wife in a very good situation. And I want to share one other thing. I've had clients pass away. I had a 41-year-old client pass away. And guess what? He took all of my advice. He had the high cash value whole life. He made up the difference with term insurance. And when he died 3 years after, about 3.5, 4 years after we met, his wife did not have to deal with a financial tragedy on top of the tragedy of losing her husband at a young age. So there is huge value in what we're talking about. You cannot put a price on what we're talking about. Right. Whole life insurance is an asset that will bless you and your family for generations.
Absolutely. So Barry, one thing or two things, these policies have a growing death benefit. So if you could speak to that, and then also, like, the longer you live, the greater the death benefit. So aren't we kind of encouraged with this product to just live as long as possible and enjoy the fruits of our labor?
Yeah, I'm so glad you said that, Jason, because you're right. In a properly structured policy, the death benefit is growing. And that's missed in some of these conversations that you're hearing out there on the internet, that, you know, the death benefit stays level and your family isn't going to get much and the insurance company keeps your cash value, blah, blah, blah. Not in these policies. I show people often that your family gets more. So if you start off with a $500,000 death benefit and you get to 85 or 90, you might end up leaving a $2.5, $3.5 million death benefit. That is huge. So again, properly structured whole life insurance is much different than traditional whole life, and the growing death benefit, it's advantageous, one, to live a long time, but also know that you can leave a larger legacy.
There's one other piece of it, and that goes to long-term care kinds of things too. You know, we're in this climate where healthcare is, you know, continuing to skyrocket, and you got people living longer. So a lot of people don't realize, right? You can draw down on the death benefit as well if you need to for those things. So again, to Jason's point, encouraging people to live longer.
Yeah. Yeah, these are called living benefits. Chronic illness, terminal illness, critical illness. Spend your own death benefit while you're alive. You don't have to die to enjoy your death benefit. There are even other things that I teach about life settlements where you could spend the majority of your death benefit if you wanted to. But people are hearing whole life insurance and they automatically throw up their hands and say, I don't want anything to do with it. And that is because they're believing what's being said, or, and I'm going to say this nicely, it's coming from a point of ignorance, which just means they're not educated about properly structured whole life insurance.
Right. And this is all near and dear to all of us. I can tell that just the energy that we're having in this conversation, that grinds me to the core when I see, I think there's a tendency to kind of fixate on the sexiest things in our culture, the fancy return, the flashy investments, whatever it is. And it's like, I think you've mentioned it, Barry, the slow and steady wins the race. This is not necessarily slow, but it's a steady effort over time, building and building and building. And there's something about that. So that when in your grandfather's case, he had a huge legacy built in his later years.
Yeah. Yep. Agreed.
And I've seen it the opposite. I've seen a lot of cases as a planner where people got hit at the wrong time with downturns, crises, and all these things. So there's that, that piece of it to try to protect against that.
Well, imagine, Steve, if you had this policy in place when those downturns hit, right? Yeah. I mean, Barry going through the 2008, what he had to go through, how different would it have been had you had all these policy, this cash in your policies ready to go?
Yeah.
Yeah, and you can take advantage of the downturns at that point, which is a great point. I mean, if you're in that position because you built something that is solid, it's like the house upon the rock kind of a concept.
Yeah, we shouldn't be speculating with money right out of the gate. You want to build a solid foundation. What's guaranteed? Where are your 6-month emergency savings? What are your tax consequences? I love sharing this. Picture in your mind 3 circles. First circle represents the bucket of tax-deferred money. The second circle represents the bucket of taxable money. And the third circle represents the bucket of tax-free money. Which one do you like the best?
I want to get it all in the third.
Yeah, tax-free.
Yeah.
And Jason, 100% of the people I ask that question give me the same answer. They want it in tax-free. But here's the next question that's very telling. I'll ask this. Where is most of your money?
Right.
And now they have like this epiphany, like, well, none of my money's in tax-free. What am I doing? Why is most of my money in tax-deferred? This is a wake-up call. You want tax-free, but most of your money's in tax-deferred. Why are you doing that?
So
it's
that brings up
you're following traditional advice.
Right. That makes something, so when I hear this, I think about how if I'm putting a large chunk of my income into a policy, once it's in there, that's after-tax dollars. So now I'm funding this policy with dollars that if I do it correctly, I'm never getting taxed on this money. Yep. Either through the death benefit or when I take out a policy loan or maybe in retirement if I choose to withdraw up to my basis, whatever that I choose to do. This is tax-free money. So the returns automatically go from 5% to what's tax-free money? 6, 7, 8, I don't know. So yeah. I just jumped up in my tax, return or my rate of return because I'm not getting hit with taxes and it's on my volume, right, of my income. That's amazing.
Yeah, you're right. Tax-free is a huge benefit that if done correctly, everyone's going to get that we work with. And when you consider getting into retirement and you've got the tax-deferred money coming to you that's 100% taxable, maybe some taxable buckets of money that's coming to you, now you could potentially take less money out of those accounts to lower your tax bill, your tax burden, and make up the difference with the tax-free money from your life insurance policy. That's huge. We would love to see
tax-free retirement strategy.
Yeah, that's right.
Yeah.
Yeah, love to see people using this money 100% tax-free, but along the way creating more wealth throughout their lives.
I love what you said about having an emergency fund and these kind of things. It kind of goes to what we were talking about earlier with pundits and a lot of opinions that are out there. The funny thing is that a lot of the things that we're saying harmonize with perfectly. Well, everything we're saying harmonizes with financial peace and these kinds of goals. Just leave that there. I mean, they really do. And we're all about that. I feel that in this conversation with you guys. And I think that's the goal.
So if I said to someone very simply, do you have anything in your portfolio that's guaranteed liquid and tax-free? Most people answer no. But then if I ask, do you want that? Again, nearly 100% of people say yes. The only place to get it, all together, liquid, guaranteed, tax-free, you want that, you can only get it in a high cash value your whole life. So we need to shift our thinking. We need to shift the mindset. We need to shift what we're being told and maybe question, this doesn't sound right that I'm hearing from these financial entertainers. Maybe I should look at it myself. Because look, you've got to get into the education yourself, right? I can't go eat the pizza for you, right? You've got to get the education yourself. So, and that's part of the difficulty up front. I love what Garrett Gunderson said. I learned this from him like 15 years ago. He said, hard, easy versus easy, hard. This is a principle I've taught my children. Do the hard, easy route. In other words, do the hard things now so that you have an easier life in the future. Unfortunately, most people do the opposite. They do easy now, and they've got this difficult life ahead of them. Mm-hmm. Grind down, get the education now, set money aside now. Don't wait till you're 55 to start planning for retirement. So you do these things now, the hard, easy. Yes, it might be a little harder now, but I promise you, you will have a better future.
Yeah, and
this is a principle that will pay off.
Absolutely. I'd like to mention or highlight the fact that on our website we have tons of information on everything we're talking about here. You can read, you can go deep into all the things, free ebooks and everything else. And I mean, how many countless webinars have you done for us? So the education, it's there for the taking. So you can catch up really quick with all these things we're talking about.
If you're a reader, you could also read Nelson Nash's book, I suppose. It's a good start. Kind of had a resurgence of his book and people we've talked to lately, it seems like. So, yeah, that one's kind of timeless in terms of an introduction.
Barry, I want to touch on two things. One is this kind of additional benefit of whole life, of the permission slip strategy. And then the second thing I wanted to talk about is how does this properly designed whole life policy help when you're sitting on money and you don't have the best opportunity in the real estate market and you're wondering what to do? So those two questions, if you could kind of address that.
Yeah, let me start with the last one. And I've seen this because I work with real estate investors. Real estate investors hate sitting on cash. They want it put to work. And when they're sitting on cash, they feel like this money is burning a hole in their pocket, right? They're like, oh my gosh, I got to find a deal. And I've seen real estate investors make bad decisions because they were so anxious about getting that money to work that they settled on a deal that was okay, but it wasn't great. And what I tell real estate investors often is, look, if the money's sitting in the policy making 5% or more tax-free, you don't have to be in a hurry to go find a deal. You're making money. You're earning an annual dividend. Be patient and find the deal that you want. You're going to have a much better experience in the real estate world if you're holding the cash in the policy as compared to in a taxable bank account feeling like the money's burning a hole in your pocket. Yeah. And look, by the way, you can take your death benefit as a real estate investor. You can walk into a bank and put that up as a collateral assignment, and you become a more advantageous borrower to the bank. We haven't even touched on this, but the idea is you can use your death benefit as a real estate investor right now, today, with a bank to borrow more money. The overall idea of making better decisions because you have a policy becomes very apparent when you start using the policy in your life. And to your other point of, remind me again.
Yeah, no, so it's kind of the same thing in a sense. It's permission slip. Because now you're not, it's like you don't have to rush into things. You don't have to, it brings that peace of mind knowing that I have permission to spin down other assets because I have this other asset that when I die will pay out to my beneficiaries tax-free.
Yeah, that's right. So we don't know what estate taxes are going to do in the coming months, in the coming years. They could change dramatically where they begin to affect a lot more people. And when someone passes away, the government's going to wind up with millions and millions of dollars more because of the estate tax. Well, the permission slip idea is allowing us, by having a whole life policy, to spend and enjoy money while we're alive. And sure, you can pass it on, but wouldn't you rather pass it on tax-free to your beneficiaries and spend and enjoy all of your money? So what I'm saying is that by having a permanent death benefit in your portfolio, let's say it's $2 million. You get to age 85, you got a $2 million whole life death benefit. What I would have taught you, what I would have said and encouraged, I'm even telling my own mom to do this right now, spend your money. Don't give it to all of us kids. Spend your money. You've got the money. Go buy a car. Go on.
How old's your mom, Barry?
Spend the money. 77, 78, somewhere.
Oh, okay.
Yeah. Yeah. Spend the money because she's got whole life, and so does her husband. But the idea is that if you've got a $2 million death benefit and you know it's a guaranteed payout when you pass, that gives you the permission slip to go spend and enjoy $2 million of your own money. You don't need to hold on to the 401k, the IRA. You don't need to hold on to your.
Try to pass one of those to somebody that's not your spouse. That'll make your head hurt if you start looking at how the technicalities of that, and it continues to get chipped away at by our officials. That's become a real hairy thing.
Yeah,
so, one of the
things you're.
Yeah, well, when you pass an IRA to
right.
one of the kids, for example, there's requirements around that, and the distributions you can't stretch them out for.
Quickly.
Yeah, so compared to just a check with no strings attached, it's quite a different deal.
You're right, and my mom and her husband are in a lower tax bracket than I am. Okay, if she leaves me IRA money when she dies, I'm going to be paying more tax on her money had she just spent and enjoyed it.
Yep.
And people aren't thinking of that. So if you're a parent or a grandparent and you're going to leave money to kids or grandkids and it's qualified money and you're in a lower tax bracket, you're forcing your children and grandchildren to pay more tax and give the government more money because of your strategy.
Yep.
You may not want to do that.
Yeah, and you're also giving them a technical thing that they have to hire someone to help them do for for at least 10 years. So it's just another piece of their CPA if their CPA even knows how to do it. So one of the things I love about this asset and what we're talking about is it's just simple. It's liquid at death. There's no strings attached. If it's a spouse, they get a check. If it's kids, get it in a trust. They can get, they can have a check. It's just, I love especially the older I get. For some reason, I love simplicity. I like things that don't require a lot of banging your head against the wall. And it just, if you really look at what this gives people, to me, this is freedom and simplicity. One asset of many that stands out. Being a very simple and great
So
support.
based on what Steve's saying here, Barry, Can you? I want to move into mindset in a second, but I want to have you touch on what Steve just said, because that peace of mind that it gives to people, like the emotional aspect of knowing, like you told a story once about you and your daughter. Like if you could kind of touch on that, you guys went parachuting.
Yeah. She was 15, ready to turn 16, and I said, "What do you want to do for your 16th birthday?" And she said, "I want to go skydiving." And my gut, dad reaction internally was, "No way! I have 5 children. Like, no way." And I thought about it, and so I didn't give her an answer like right off the bat. I thought about it, and I said, "You know what? I've got multiple life insurance policies. If something did happen to me, my family's taken care of, etc." But I also wanted the experience. So I told her, yes, we're going to go. And we found what we believe is the only place in the country that would let a 16-year-old go skydiving. And we jumped. We had to do it separate, and we were tandem with with an instructor. But we jumped over the Grand Canyon and Lake Powell in southern Arizona. It was incredible. I've told everyone, if you ever get a chance to go skydiving, go skydiving. But contrast that experience that I had, knowing that I had life insurance coverage, that if something happened to me, with a story that I tell of a client of mine. I was on the phone call with him. He said, "Barry, my life insurance policy isn't approved yet. Like, we've got it in underwriting. It's not approved yet. I've canceled my family ski vacation this weekend because I'm not approved." It's sad, and it was good that he was planning, but he didn't get the memories with his family on this family ski trip because he was worried about, hitting free or something. But the peace of mind is huge. And not only is it a permission slip that we've talked about, but it does bring peace of mind knowing that if something does happen, you're covered. But I didn't go on that skydiving trip with any fear. Right. I was thrilled. And it was cool when they opened the door and I'm looking at the ground and the winds coming in, and your mind's like, "You're not supposed to be doing this." I was so excited. I was just absolutely thrilled, and I loved every minute of it, but I wasn't worried. And that's powerful, to know that life insurance can provide not only peace of mind, but can allow you, if you'll choose, to have some of these amazing experiences in your life, right?
It's a great story. The umbrella, it's an umbrella, right? I mean, that I think there's companies that use that graphic, but it really in that way feels like that it just covers you. And yeah, what a great story. Now we know why you're such an adrenaline junkie, Barry. So we remember it wasn't too long. We were all jet skiing on kind of a team builder, right? And I think you were trying to jump off cliffs or something. So now I get it, You knew you had the coverage. It was there. Everybody's taken care of.
Right. And even just taking this one step further, the experience that I had with my daughter, we still talk about it today. Those are lifetime memories that if I didn't have the life insurance coverage, I probably wouldn't have gone. With 5 children, I probably wouldn't have gone. But having that experience with her, still talking about it today, and to feel even the excitement again of talking to the two of you about that, these are things that we want people to experience, whether it's jumping out of an airplane or even going on a vacation or doing something that they know they don't have to worry about because they have the protection. Look, people are dying every day. And we don't want to make this about death, but the fact is we are all going to pass away. Do you want to leave your family a legacy or don't you? Are you going to plan today or are you not? You have an opportunity to change your life and your family's life. Why not do something about it? For the little premiums that it takes to get coverage, and then let alone build up cash value to enhance your life, this is an investment. Not only is it an investment in you and your family, it's an investment that's guaranteed, liquid, and tax-free. Huge.
That's another thing we didn't even talk about on this call, but and I don't want to get into it too much, but when you put 10% of your money into a 401k and then you die prematurely, there's nothing. You've got the 10%. That's about all you have.
Yeah, there's no death benefit with a 401k. And there's no tax-free with a 401k.
I'm still buzzed a little bit from this legacy thing, Barry. Those are some great stories, and your grandparents too. That one we covered pretty quickly, but what a great memory that is for your going on trips with them.
Yeah.
And it's funny, we do talk a lot about the financial side, the technical side, but this incredible stability and support that comes from this approach, I mean, to me is really, really good to remember. So
Barry, one last kind of topic here is mindset coaching and or just coaching in general too. So I know you're an advocate for proper thinking, abundant mindset. How do you, if you have a client, and what's kind of your style of how you coach them, how you help them?
Yeah, and again, this is a great segue because I just had this experience this morning. I was talking to a 58-year-old client this morning. He's actually stuck in Florida, lives in Kansas, but stuck in Florida because of the hurricane. So I was talking to him at the hotel, and we're going through his illustrations. And he said to me, Barry, what do you do for me after the policy started? Like, what do I have with you? What's our relationship? I said, well, first off, it's a long-term relationship. When you take your first policy loan or you're ready to, I want you to call me. If you get approached about other investments, call me. Let me give you a second opinion so I can say good, bad, or indifferent. Right? I want to be a member of your financial team and help you make correct financial decisions in the future. Now, some of that's going to come with the hard easy, right? You still got to put in the work. Watch the webinars, watch the videos, read the books, read the articles on the Insurance and Estates website. Get on our drip email list so you're getting this content month in and month out. Education is still going to be key even after the process is over. But I love consulting with clients. I've got an email in my inbox right now, clients asking me about real estate stuff. So I want to continue that relationship, and I'm not charging a fee to do that. You become a client of mine, hopefully you're going to send referrals to me and you'll have more policies written in the future on children or second, third, fourth policies on yourself. But I do want to become a member of your financial team, and we can even help with CPAs and estate attorneys, etc., to make sure that you're getting proper education and proper financial planning, not just now, but throughout your life. I've got a book coming out. We're not going to go into much of that right now, but we're excited about it because we talk a lot about this in the book. And the book is going to help people to see how they can live abundantly now and also leave a lot of abundance behind.
Right.
But it starts here, Jason, like you're asking. It starts here in your mind. You have to shift thinking in a way, one, that you believe these things are possible, but two, shift your thinking to say, maybe what I've been taught isn't accurate. And why wasn't this stuff taught in school? Or what are the wealthy doing that I can follow? We touched on this a little bit earlier. You look to people that are successful and mimic what they do. It's really not that hard. But a lot of people just aren't willing to put in the work to shift their thinking, to shift their mindset. The world is a very negative place. Turn off the news. Turn off the crime shows and all the murder crap out there. Get good things in your life, right? You can choose today to have an abundant future. You can shift your thinking today to think positively and optimistically and serve other people and do those things that you know in your heart and your gut are right. Not only correct financial principles, but correct life principles. These things bring happiness and joy and abundance. We want that all in your financial plan, and it's possible. We live it and breathe it and do this day in and day out.
Excellent.
It's great stuff, Barry. You're a force with our mutual clients, and on the education front. We appreciate you. This has been a great talk. Really glad that you opened up and shared some things from your experience. Jason?
Yeah, it's been a great conversation, Barry. Thank you. I'm sure this is super valuable to any listeners, so hopefully they enjoyed it and can pass it on, because we're out here trying to help people.
Yeah, thank you.
Got it.
All right.